talking. Start in 2 minutes. I waited 2 minutes, like I was told. So thank you all for coming, and thank you for being flexible for the venue change. Out of our control, we appreciate Rebecca being flexible as well, and this is just exciting. There's such good energy in the room, so I'm excited to hear your questions later that I know you all prepared, so we'll get there. So right now, I'm just going to introduce myself. My name is Patty Putnam-Rankin. I'm chair of the business department, management department. We're so glad to welcome you tonight, or this evening, or this afternoon, to the James C. Jones Jr. Seminar in American Business. The Department of Business Management celebrates its 40th anniversary this year. We have a rich history with 40 years of teaching business management as an active liberal art. As we move forward to our 5th decade, we celebrate this tradition by pursuing AACSB accreditation and continuing to focus on social impact and the global nature of business. Looking around the room today, I'm overwhelmed by how proud I am of our students. Tamara, how many days for seniors?
It's like 56.
56 days. I would like you to cherish every moment, but make sure you get those SCs done. We are really proud of you. I see some athletes in the room today, so I appreciate our coaches for having our athletes attend today. It's really important. Ben on the tennis team, right, is here, and I think the whole tennis team is here, right?
Yes.
Yes, thank you.
Better be.
We know the challenges you face as you balance team commitments and your school activities, so we are proud of you. Finally, who's here from the AMA, American Marketing Association? We have some.
Hi.
And what about those going to Quinnipiac this week? Some more? All right, so we know that you're going to represent Washington College well this week in New Orleans and in New York, and good luck. We're proud of you. Rebecca, we're proud of you. Rebecca is a shining example of how we transform students into leaders to create better worlds. She led an amazing networking event with our students today and gave unforgettable lessons to them. Most importantly, she listened to their hopes and their concerns. Thank you for being here, Rebecca. We all look forward to your talk. I would now like to introduce Dasha Shirokova. No, I didn't do it right. She told me. Shirokova. I would now like to introduce Dasha Shirokova, who will welcome our new inductees into Sigma Beta Delta, the Business Management Honor Society.
scholarship and accomplishment among students of business, management, and administration, and to encourage and promote aspirations toward personal and professional improvement and a life distinguished by honorable service to humankind. Sigma Beta Delta was established to honor students who have attained superior records in business programs in schools and colleges with regional accreditation. I would like to recognize our new inductees for 2023 who will be inducted later this evening. Now I will read the name of each candidate and ask you to please stand to be recognized. Remain standing until I have named all students. Audience, I ask you to hold the applause until all the candidates have been called so they may be recognized as a group. Charles Crouch, Bianchi Danai, Sierra Deemer, Kate Gramacki, Anthony Pinto, Dylan Smith, and Alexis Stackney. Thank you. We look forward to your induction this evening. Now I would like to welcome Dr. Sosalski, President of Washington College, to introduce our speaker.
Great, thank you so much. I always get to come in and do the best part. Well, listen, good afternoon, everyone. It is so exciting to see such a full room today. This is pretty exciting. And we just won't tell the fire marshal what we've done today. But I know that Rebecca will burn it down. So, sorry about that. Was that a dad joke? Well, listen, I get the pleasure of welcoming you all to Washington College and to the James C. Jones Jr. Seminar in American Business. Endowed in 1978, the Jones Seminar brings some of the brightest and most innovative minds in the business world to our campus to share their experience and wisdom with our students and with members of our community. And I'm really delighted to see lots of those folks here today. I'm really delighted to introduce you to this year's speaker in particular, Rebecca Corbin-Lurady, class of 2000. A pioneer in investor relations globally, she is a renowned capital markets and investor relations strategist, and also a trusted advisor to boards and executives worldwide who seek her research-based insights and counsel. Rebecca founded Corbin Advisors in 2007, and the company quickly developed a reputation as a best-in-class partner. Over the course of 15 years, Corbin Associates has conducted more than 20,000 investor and analyst interviews for more than 850 companies around the world, representing more than 225 industries. In addition to this, Rebecca is a highly sought-after public speaker and subject matter expert. She has spoken at the World Economic Forum in Davos, Switzerland, and is a recurring guest on CNBC's program called Squawk on the Streets, which I have to think had to be inspired by Gus the Goose in some way. She is also deeply committed to nonprofit causes, creating the Corbin for Nonprofits initiative, and also serving on the board of the Bushnell Center for the Performing Arts. And she is also a past director of the Hartford Symphony Orchestra and Connecticut Women's Hall of Fame. Last, and to my mind most importantly, Rebecca is a distinguished and valued member of the Washington College Board of Visitors and Governors. So she's impacting our lives here on campus in many, many ways. Before we invite Rebecca up to the podium to speak, however, I would like to share with you a short video with more about the work of Corbin Associates. So please direct your attention to the screen.
Corbin is an innovator. It's an intrepid company. We have been through very challenging times, starting with being founded right ahead of the great financial crisis, to COVID, where we led through our research-based advice to our clients, helping them navigate a very challenging and complex market, to today, at 15 years, with over 60 employees in 11 different states, hundreds of clients around the world, delivering value and excellence.
We've been building our Corbin database for the last 15 years, and it's still growing. That gives us unique opportunity to provide transformational insights to our clients, and also gives us benchmarking capabilities, which really sets us apart. We've been publishing our flagship Inside the Buy Side every single quarter, and we've published over 50 issues, and that takes commitment and discipline.
As a thought leader and expert in factors that impact valuation, we take pride in leading the way on how companies drive value for key stakeholders, including employees, customers, investors, society, and planet Earth. From assessing and quantifying opportunities to find ground truth and unlock value, to architecting and activating strategies that serve to sustainably re-rate and compound valuation, to accelerating performance and organizational excellence. By consistently delivering above and beyond expectations, we earn our clients' trust. That trust allows Corbin to fulfill our purpose, to add value in everything we do.
What sets us apart at Corbin is our people. This culture that we have built here at Corbin is one that lets us all achieve our best every day.
Our hypergrowth and success has been driven by our commitment to clients and value creation, but also a commitment to our people and our culture.
What makes me feel most accomplished and proud of working here at Corbin is getting exposure to C-suite executive management team and working with our senior leadership team on driving value for these companies.
Corbin stands for excellence. There's a strong sense of pride with any work that we do in-house or with our clients.
Great foundation from the history with a constant commitment to innovation is really what makes us powerful.
Several years ago, we founded Love Corbin, which is our community impact initiative.
I think it gives people the opportunity to give back. Kind of what makes our culture unique in itself is that we have all of these like-minded folks who really want to do whatever they can do in the community and to make a difference and make an impact.
Our Love Corbin initiatives are probably my favorite part about this company. I think I've been to every single event. You can tell that the people we work with all care about our community.
When I think about the next 15 years, as I always tell my team, onward, onward together. Onward!
You're going to get a lot of job applications.
I hope so. Hiring.
So listen, that was wonderful, and I just now have the pleasure to introduce you to our wonderful alumna, Rebecca Corbin.
Hi.
Thank you.
Hi everyone, thank you so much for coming today. That was a little bit about Corbin Advisors and Rebecca Corbin as the entrepreneur. And now I'm going to talk to you about one of my passions and subject matter expertise, which is the equity markets and investor sentiment. Just a little bit of background, I came to Washington College by way of a guidance counselor who introduced me to this wonderful little gem on the Eastern Shore. I had never heard about it, like probably many of you in this room. And I truly have such a dedication and a commitment to what Washington College did for me, including Professor Harvey over here, who always tells me to call him Michael, but old habits die hard. And I was cared for and loved and given, and Holly and Fred, who were part of our tennis culture. I was captain of the tennis team, played for 4 years. But the dedication and commitment of the faculty and staff, the personal touch that you receive as a student, as I receive, and I know all of us here still continue to receive that, decades later, really shaped me and helped me blossom into the citizen leader that I am today. And I'm looking forward to taking you through some of our research and sharing my experiences after leaving college and what else it's done for me. Just by a show of hands, because I always like to calibrate my level of insight to the knowledge base of the group and also the experience. So just by show of hands, how many people follow the stock market? How many people follow the stock market pretty religiously? Okay. How many people don't follow the stock market but are interested in the stock market? Okay. How many people have ever listened to a public company earning call? All right, so I'll calibrate on that level. So I'm gonna give you some education, and hopefully, you know, we'll have the opportunity. You can ask me any questions with regard to what we discussed today. So I'm going to talk about demystifying Wall Street's equity markets. If you are not following the markets, but you read newspapers and you understand what's happening with the banking sector and SVB, you obviously are not living under a rock. Hopefully, you know that we're in a slowing growth economy after the golden 21, as I like to call it, when things were gangbusters. And there's a lot of news out there and a lot of news flow. And what we do at Corbin Advisors is very, very big data research to be able to, what I call boiling the ocean, taking all of that research and trying to get to a point where we have actionable insights that we can act on. And the people that are acting on those insights are the folks that we're advising. And the folks that we're advising are publicly traded companies from pre-IPO all the way up to 360 billion in market cap. So the top 10 largest companies in the world are at that level. And we call them our clients. And specifically, we are advising their board of directors and their CEOs and CFOs and their leadership teams on how to navigate, as a publicly traded company, the equity markets to be able to attract institutional and retail investors to become shareholders of the company. Where should I be clicking? Yeah? Next. So just a little bit, as the video mentioned, and that was, we did that for our 15th year anniversary, which we just celebrated in November. We were founded in 2007. One woman shop on the floor of my New York City apartment, no clients. I still remember to this day my computer on a box because I had just moved into a new apartment. I sold my apartment and was waiting for the next one. And you know, that's pretty daunting to start a company that is focused on trying to understand what's happening in the markets during the foothills of the great financial crisis. So to one woman, you know, one product, all the way to today, where we actually are cresting 70 associates at our company, folks who come from the Wall Street, the buy side, the sell side, investor relations, corporate development, investment banking, M&A, etc. And we have three main practices. So we have our insights group, which really is around that assessing the company, right? You should consider us to be stock doctors. Companies come to us because their stock generally isn't working. It is underappreciated by the market, it is undervalued, or they come to us because they are super athletes, but they need that injection into their performance to be able to even outperform at a higher level. So that's as simply as I can describe what we do. And we do that through market research, where we're conducting very in-depth interviews and surveys with professional investors, what we would call the buy-side institutional investors, Wall Street, globally, they're all the same thing. And we're asking them about strategy and performance and the management team, all the factors that impact a stock's valuation. So we have to first make a very in-depth assessment of where is this company excelling, what are their strengths, and what are the opportunities for improvement, what are their weaknesses. We also do research as a service. We do a prolific amount of research. We get paid for that research through our clients. The second is that we're now developing strategies, so we're architecting strategies based on that research, and we're activating strategies in the open market. And that's what we do through our advisory group. So we are retained advisors to public company executives, and we are helping them develop their investment thesis. We are helping them communicate more effectively with the financial community. We are putting on massive events where we would have hundreds of investors come to hear management pitch and talk about their company. And then we also do special situations, activist defense. We do massive transformational M&A communications where we are instrumental in writing the press releases, putting together management's prepared remarks, putting together the presentation that the management team will use to communicate the benefits of M&A to their shareholders. And then we have our community impact group. We've got a very, very strong and growing ESG business, environmental, social, and governance business, which is probably the largest megatrend that we will see in our lifetime. So ESG is synonymous with sustainability, is synonymous with corporate social responsibility. So all of those terms, I'm sure you've heard about that. And then because we're a very philanthropic organization, we develop Corbin for Nonprofits. So we take this powerhouse consulting that we do for the most elite of companies, right? Highest level, publicly traded, in the spotlight, and we bring that muscle to non-for-profits and help them more effectively fulfill their missions. We do this under a very, very strong research center of excellence. Everything that we advise on to our clients is based on our primary proprietary research. We are an industry leader in this field. It is what we're known for. We're also known for our candor. We are very direct, and our clients, CEOs who are very used to people saying yes, sir, and yes, ma'am, yes, sir, yes, ma'am, we're more like, no, we don't think so. Here's another concept, here's another idea, and we are paid to give our research-based idea and opinion because they want the ground truth. So I'm going to talk to you a little bit about Corbin Analytics. That is our database of, Mike mentioned, President Sosolsky, over 20,000 interviews with institutional investors globally, with Fidelity, Capital Research, Norgis, Abu Dhabi, sovereign wealth funds. It is industry leading in what we do. And then also I'm going to talk to you about our Inside the Buy Side, and I'm going to give you a sneak peek of our research that we will not publish until the second week of April. And every quarter since the Great Financial Crisis, we have been conducting Inside the Buy Side, where we survey 80 to 100 institutional investors, and we capture their sentiment heading into an earnings season, and we leverage that research to advise our clients on how to navigate around strategy, capital deployment, communication, and our clients tend to outperform the markets in these types of environments. So let me break it down a little bit in terms of, for those of you who are not familiar with the stock market or publicly traded company entities, every public company, and quite frankly, every company sells a product or a service, right? So you buy an iPhone, they're selling an iPhone, and they're selling the service. Let's just break it down to this level. Publicly traded companies are also selling products. They are selling their debt, or they are selling their equity. And the equity is a very complex product. It has to work, right? You can't pay for that product and spend $50 on a share and have it blow up and go down to $1. That would not be good. That would not be shareholder friendly. So they're selling a product, and their product happens to be very complex. It is very difficult to communicate the value proposition of an entire company in the time frame that companies have to do that. There's a tremendous amount of competition. Investors can invest across thousands of companies for that one or two investments. And investors are making, big investors that we deal with are making hundreds of millions to billion-dollar investments in companies. And so where this competition for capital and perception gap is, here's what a stock should be valued. So let's just say that Corbin Advisors was publicly traded, and we should, based on our value, our assets, and what we deliver, we should be valued at $100. But for some reason, our stock is only trading at $30. Well, why is that? Why is the market not appreciating what we're worth? That's where Corbin comes in. We identify why there is a disconnect with regard to what investors are willing to pay for that company and what the market will bear. And we provide that insight to executives, and it can be anywhere from, there are assets, such as businesses within their portfolio, that are underappreciated. So let's take an industrial that has an energy business within the industrial portfolio. Well, industrial analysts don't like energy in the portfolio. If they wanted to invest in the energy company, they would invest in an energy company. So they don't like to have that, and they will discount the stock. It could be that the company has gone through a lot of turnover. There's been multiple CEOs, and there's not a consistent approach to management execution. It could be that the company says, hey, we're going to earn $100 next quarter, and they only earn $30. So it could be missed expectations or mismanagement of expectations, and it could be that they're not communicating effectively. There's a whole host of reasons why this stock would be undervalued, and that is where we begin in assessing a company, just like you would any other product. So investor relations, which is what I do, is very niche. There's generally one investor relations leader at any publicly traded company. And it's not something that you go to school for, although Quinnipiac, whoever is going up there this week or next week, they do have a dedicated program to investor relations. But it's really where there is a person within the management team who is a liaison between the C-suite, the C-level, CEO, CFO, and the company's shareholders. So they are tasked with effectively communicating with investors and providing them with information about the company that is not material information, but that is information that they've already communicated, or they can communicate broad-based in an open forum. So they're really a liaison, and it's a very interesting role. It's a very interesting role. It's a very dynamic role. And why is that important? Well, according to our research and what I spend my time on in boardrooms with executives and directors is sharing our proprietary research. When we survey investors, 89% of investors that we survey globally say that investor relations has some impact on valuation, from critical all the way up to somewhat influential. And when we drill down further into best-in-class investor relations and worst-in-class investor relations, Elon Musk, Tesla, worst-in-class investor relations, even though his stock is trading where it is. If he embraced investor relations and the study of it, he could be 10 times more. But these are unicorns. Not all companies is a Tesla. Around 40% of a stock is influenced by how public companies are communicating with and engaging with their current shareholders as well as their prospective shareholders and their sell side that covers them. So now with that background, I'm going to get into our research. So again, this won't be published until the second week of April, so preliminary trends because we're not through with our survey yet. But this is what I spend my time if I'm on CNBC, Bloomberg. We do a tremendous amount of publication around this research, and it's globally followed. Now, having spent 23 years intimately tracking equity markets and having the unique opportunity to speak to professional investors on what's happening with the macro, I have a unique perspective around cycles, right? But if you haven't lived through cycles and you haven't been part of what's been happening, it's very difficult to pick up on these. So one of the beauties of Corbin is that we capture sentiment visually every single quarter, and we've been doing this since the Great Financial Crisis. So I'm going to take you a little bit back to the first quarter of 20. Now, our surveys are in front of the quarter. So Q1 is January, February, and March. This survey was conducted in December of 2019. And you can see that right before COVID, there were concerns about a recession. So heading into 2020, forget about COVID would happen in March, okay? It was already happening, that's why it's called COVID-19, because the tale is it started in 2019. But it wouldn't make massive media, and we wouldn't be in lockdown until March, right? So heading into 2020, slowing growth, slowing demand, manufacturing production was slowing, and there was massive concerns about a recession. Then COVID happened. And the reason why China is green is because there was a lot of optimism about China coming out of this pretty quickly. In terms of it began in China, as you know, and they started to hopefully come out of that. The second quarter of 20 was really where the markets cratered. Okay, companies in April, so the second quarter, companies announce earnings every quarter, and they would be announcing in July in the second quarter, following the second quarter close. And what they started to communicate was massive amounts of transparency with regard to what was happening in their facilities. They were press releasing the closures of facilities. They were press releasing how much they were cutting costs. They were press releasing that they were no longer doing dividends. Remember the airlines? There was no travel. All of this information for the first time in history was put out into the airwaves. And this is one of the differences between this recession and the Great Financial Crisis, which happened in 08-09. And by the way, smartphones would be launched in 2008. Social media really wasn't a huge focus, and most institutional investors were not even able to access social media platforms, and they're still not able to access social media platforms at their offices. So heading into the second quarter earnings, companies started to talk about, we're going to see massive slowdown. We are going to see 60 to 70% deceleration in revenue. This very big fear of everything just stopping in a vacuum. And so investors listened to that and said, okay. And they got really aligned on that expectation. And when companies presented their actual findings in July, they were down, but they were only down 30 to 40% on average. So all of a sudden, things look a lot better. I was expecting a massive cratering, and yes, it's slowing, but it's not slowing at the level of expectation that I was, and I feel better. And at the same time, companies are sitting on massive amounts of cash because they've been cost conserving and they haven't been investing, and they're still generating a lot of cash flow. So they start plowing it into the market globally. And this is what I've dubbed the super CapEx cycle that we've been in. So all of this sentiment of like, not as bad as I thought. I feel like spending. At the same time, we have a lot of positive views coming out around the vaccines, right? We will not have a vaccine yet, but there's a lot of promise. So people are feeling a lot more optimistic. Plus, it's summer. We can go outside, at least in the Northeast and the colder parts of the region. Now we can go out, and we've been locked down, and now there's some freedom. So we start to see sentiment increase, and that's where we start to see this bullishness. There will be 4 quarters of consecutive increasing bullishness. Now, when we get to the first quarter of 21, every first quarter of every year, companies come out and they communicate to Wall Street globally what their expectations are for the year. It's a very big event on Wall Street globally. And companies either guide quarterly or they guide annually with what their expectation is for their performance for that time period. They came out very conservatively. And I will actually just go back. In the fourth quarter of 20 was the first time that inflation would start to register as a concern in our survey. It would not become public referendum for about 2 quarters. Investors are 2 to 4 quarters in advance of seeing things than when the market actually sees things. So we get into the first quarter in 21, which was the golden year, and companies came out with very conservative guides because they were shell-shocked from COVID. So they came out with very conservative guides. At the same time, this CapEx super cycle is building. Everybody has stimulus, PPP, personal stimulus. Companies have cash, and all of this money is being invested, which raises the demand. Companies can't keep up with the demand. And that's why we have this impact, further impact on the supply chain. It was way before that. But there's now this massive amount of growth. And there's also a tremendous amount of inflation. Transportation costs, input costs to make things rising. And so the big question on Wall Street's mind is, can you pass that on? And companies did pass that cost on. To who? The consumer. Tomatoes at $10. It's a lot of money, but fertilizer went up. And labor to pick the tomatoes went up. And transportation to ship the tomatoes went up. So when you add it all up, it was 10 to 12% higher than what they were paying. And somebody has to pay that price. The end user pays that price, the consumer. So we get into all of this and we start to see just massive, COVID is ebbing, massive growth, massive demand. Companies are coming out with record revenue, record backlog. It is record in history how successful companies are during this period. And unprecedentedly, they raise guidance, which is unprecedented to do. They raise guidance in the first quarter and they raise guidance in the second quarter. And all of a sudden, everything comes crashing down. And investors say, something's going to break. In the third quarter of 21, they were already concerned about what was going to transpire in 22. They were already calling for it. And this is where we see a significant reversal in bullish sentiment. And it is at this point in time that Corbin, who is an alarmist to these types of changes in sentiment to our clients, that's why they engage us, begins to advise our clients that we need to be prepared for an economic slowdown and a recession, that we need to be thinking about cost-cutting activities and other downturn playbook actions, because we are starting to see slowing growth in the subprime consumer. Rent-a-center consumers, They are at the lower level of the economy. And when you take a napkin and you put the tip of a napkin in a glass of water, just the teensiest little bit of tip of the napkin, and you walk away and you come back in an hour, that napkin will be soaked. And that is how the economy works. It is inextricably linked, and it begins with certain sectors that wend their way through the entire system. The other thing that we started to see were chemicals companies, because we work with a lot of chemicals companies, talking about slowing volume. Chemicals are in everything. They support the entire ecosystem of production. Plastics, papers, everything. They're the canary in the coal mine. So we informed our clients begin to prepare, but you cannot communicate this to investors because this is at a time where our clients, even though they agreed with us or they were welcoming the view and listening, they were still seeing record revenue and record backlog, and they would continue to see that for 2 more quarters until it finally caught up with, the investor sentiment finally caught up with management actual performance, company performance. So we see this now, we're heading into 22, and 22 was a terrible year for the stock market. Why? Because we were downshifting. And when companies came out with their guidance in January and February of 2022, guess what was not part of their guide? Russia's invasion of Ukraine. Interest rates rising. That would start in March. So I'm baking a pie based on ingredients, and I forgot 2 of them. And these are headwinds. These are not tailwinds. It's, you know, the street doesn't like surprises, but the street does not like negative surprises. All of a sudden, we go into a pretty bearish state because sentiment, the street is rising up to perception. We're going into recession. I don't believe you. And companies are still talking about growth, and investors say, we don't want to talk about growth. We want to talk about how you are buttressing your balance sheets and what you're doing to pay down debt and how you're thinking about preserving your margin. So at the same time, we see this, we start to see this kind of shallow and short. These are views around what the economic recession is going to be. This hope that it's going to be shallow and it's going to be short. So we get this bearishness bottoms in the 3rd quarter of last year. Why? Because we were feeling a lot better about what was happening. Management tone and performance had finally caught up with this negative sentiment from investors, and investors just need to have their fears answered. And when their fears are answered because they don't like uncertainty, and up until this point they were uncertain. Am I right in thinking that we're going into recession? Are we really seeing slowing growth? And then companies started to announce and pre-announce. We have to pre-announce because we're not making our quarters. Dow, you know, lots of different companies were announcing layoffs at this point. So we go into this bit of a tailspin. And finally investors say, okay, it's as bad as I thought it was. Now I can actually place my bets. But then what happened to today? We're back in the bearish camp. Why? Because of the financial crisis that we're in now. And the banking system was not part of the earnings guidance that was provided. That happened after. And it sent a shockwave through the system because now this is pretty serious. This is pretty serious. When you have financial institutions blowing up because of interest rate movements, this becomes very serious. And so now we are at 50% bearishness. And of course, the positive sentiment happened in the 1st quarter. The markets actually, you know, trended upward because the guides were better than expected. But now we're in this last capitulation of, or at least we think that it's probably a last capitulation of market uncertainty. And so you can see we've got interest rates are the biggest concern. China is a huge concern. Inflation is still very, very specific. So lots of red, unfortunately. There is some optimism though. So this is just to show you kind of where investors were, right? They're way ahead of management. Why? Because investors are paid to be skeptics. They are paid to be skeptics. They are looking for what could go wrong, while I'm also hoping for great opportunities. So you can see that now we have merged where management tone in the fourth quarter of 2022 was much more negative than investor sentiment. So we've only seen 2 times where management bearishness crosses over investor bearishness, here and right around when the pandemic started. Not good. When we look at what are the most concerning areas for investors today, US-China relations, monetary policy, inflation is still up there, ability to pass on that cost because inflation is still there. It's ebbing in some places, it's retracting in certain places, like transportation is lower, input costs are lower, but healthcare, labor costs are higher, so they're still dealing with it. The impact of a war, FX headwinds, talent and labor, although that's a lot less. Why? Because there's not as much demand. When you don't have to produce as much, you don't need as many people to produce those goods, and supply chain disruption is down. China, when we've been surveying investors on companies with exposure to China and what level of risk are they assigning, and it has been above 65% for 3 quarters now. Companies with exposure have an overhang on their stock. Remember that stock diagram I showed you? So if you have a lot of exposure to China, it is serving as an overhang on your share price right now. Big focus of investors is capital deployment, also known as capital allocation. Right? Where do you invest your money? And generally there are a finite number of things that companies can invest their free cash flow toward. Debt pay down, you can conserve cash, you can reinvest in the business, organic to spur organic growth. You can reinvest, or you can invest in M&A, or what we call inorganic growth. You can pay a dividend, and you can buy back your shares. Capital allocation is very specific for each company. Why? Because not all companies pay dividends, not all companies have acquisitions, not all companies have high debt levels where you need to pay it down. But in general, what this says is they are very defensive in their views. So if you are a company that's considering a major acquisition right now, you can likely bet that your stock is going to be down anywhere from 12 to 20%, as history has shown us. We're working on an acquisition right now with a company, and I have communicated to that management team, just so you know, transformational big acquisitions are out of favor right now, so you are going to take a stock hit. And we go eyes wide open. We don't change because there's a lot of opportunity to buy assets at cheaper valuations during this time, but you're going to get the unfortunate double-edged sword of losing valuation. Big focus on debt pay down and securing your balance sheets. Now this will be kind of 401 level, but there's a metric out there that investors use to evaluate the balance sheet strength of companies, and it's called net debt to EBITDA. How much debt do I have relative to the EBITDA that we're making? In these types of markets, EBITDA goes down, so your debt levels can balloon in terms of your net debt to EBITDA, but generally speaking, they're looking at 2 times. In the great financial crisis, we had companies that were at 8, 9, 10, 15 times. Those really don't exist anymore, which is why this is also very different from the great financial crisis, because companies have paid down debt, they have very strong balance sheets, okay, and they're eyes wide open with regard to what's happening. There's some bright spots. You saw that green up there in terms of bullish sentiment, and the bright spots are that we have this infrastructure bill that's massive awarding of monies to different areas, and there's about 11 states right now that are beneficiaries of 50% of that current funding. And funding is already starting, so that's another part of stimulus, right? The government is going to provide some stimulus, and we saw that during the hangover of the great financial crisis, where we saw a lot of infrastructure building going on, supported by the government. Second to last slide is really the bulls and bears. So this is where we see technology is starting to ebb back. They were completely out of favor for the last 2 quarters. We're starting to see, because the valuations are so low, investors are starting to invest more in technology. Never bet against technology, ever. Like if you see technology down in the stock market, find some bellwethers and buy them, because they will always go back up. They've been #1 in our survey for 10 years. Outside of these types of markets where they'll be kind of whacked because they're not a defensive play, but energy, healthcare, industrial starting to gain because of the infrastructure. Financials, If you've got a rock gut stomach and you want to take some risk, financials, right? JP Morgan gonna go down? I don't think so, but their stock's on sale. There's a lot of designers on sale right now, and if you follow the markets, you know when to go after. But in order to make money in these markets, you do have to spend some time finding companies that you're gonna follow and wait for them to be down 20 or 30%. And while they may go down, because we're not yet through this part of the woods, we still have fallout from this economic situation we're in. Again, the markets, if you look over time, they always go up and to the right. So I want to leave you with this, after doomsday of my presentation, how do companies actually navigate through this? Why wouldn't they just crawl into a hole and just wait it out? Worst practice, by the way. You want to be more proactive. You want to be more communicative when you have crisis like that. Like any company, any organization. There are 5 critical factors, and this is the genesis of my life's research and my firm's life's research. If there is a slide in the 850 slides of research that we have, this is the one that is the big so what, which I've trademarked, by the way. Number 1, why would an investor invest in a company? 20,000 plus interviews across the world. What motivates them to buy a company, Corbin or some other company? Number 1 is leadership quality. Do I trust the management team? Are they credible? Are they honest? Are they telling me the truth? When crisis happens, do they sugarcoat it, which is that's not a best practice. You want to be telling them like it is and having a strategy to get through it. Do they have vision? Do they have operational capabilities? Number 2 is there a clear long-term strategy? Typically, investors like strategies in the 3 to 5 year camp. They like financial targets every 3 years that companies are trying to achieve. And event-driven, like COVID, right? There were companies, when COVID hit, every company, the playing field was level. And if you were an underperformer up until that point, you could actually leapfrog and outperform just based on how you navigated that crisis. So long-term and event-driven strategies. Execution track record. Can you look at what I've said and what the company has done, and are we delivering on that? We call that the say-do. So that's where transparency comes out with regard to, you can't get credit for something if you don't tell them that you're going to be doing it. But there's risk in telling what you're going to be doing because it's in the future. Best-in-class companies have a very strong track record. Sustainable competitive advantages, and the top 2 that investors identify, tied for number 1, are high barriers to entry and operational excellence. Those are the most compelling sustainable competitive advantages that they view for companies. And then 5 is capital deployment, which we went into. So that's a little bit of my world. Hopefully you were able to glean some insights from that and the history of living through the markets. I love equity markets. I love working with publicly traded companies. I love having an impact on the stock market. When we publish our research, especially our sector research, we move the markets based on if we're saying that that investors are bullish or bearish. And so it's been a fun journey, and it all began at Washington College, who taught me not necessarily this subject matter expertise because you have to learn on the job. They taught me how to lead. They taught me how to problem solve. They taught me how to be confident in myself and what I do. And they taught me how to be a fairly organized, diligent, persevering person. So I owe a lot to my success to Washington. And now I'm going to call up Ciara and my colleague Lucas, who is 2016 alum.
And I'm just going to give a little bit of a logistical alert. So Ciara's going to start with a question for Rebecca. And then we do have other student questions, so we'll open it up at that point. So get your questions ready that you will have to ask. And I'll kind of go around and when we get to that point in Ciara?
So I'm Ciara Deemer. I'm a business management and economics double major. And I'm going to ask a few questions. First, at Washington College, several of our students are interested in jobs in consulting. So could you tell us how you got started in that?
Sure. I had a very non-linear trip to where I am now. I did not graduate with a job. I was following my passion, and my passion happened to be becoming a professional model, and I did that, and I had the opportunity to do that while I was at college and after college. And like everything that you hear, it's all about your network. And at some point, I really wanted to leverage my education and what I learned at Washington College. I was not stimulated mentally in the world of modeling. It was not for me. And so I decided to start to reach out to my network. And I had a family friend who ran a stock surveillance company, which is very, very niche in this industry. It's a very unique expertise. And he said, I can get you an interview. He didn't say he could get me the job, but he ran the company, by the way. He said, I'll get you an interview. And I got that interview, and I just happened to land in this world of equity markets and consulting. And I'll tell you, I knew nothing. You know, I was in a class of 26 students who had just been hired, and they came from MIT and all of these other schools with very deep finance internships and experience. And I was a fish out of water because I came from a liberal arts background, and you know, I was a business major, not hard finance. And I remember the first assignment that was given was list the top 20 companies by equity assets under management around the world. I didn't even know what equity assets under management was, and I certainly didn't know what any financial institutions were. These would be Fidelity and BlackRock and all of these others. So I was just looking around, and thank goodness we were in a group of 3, and my colleagues knew. And for the first 3 months, I was in over my head, really. And I'm not a quitter, but I was like, maybe I'm in the wrong business. And then, after just persevering, studying, ramping up on finance and equity markets, one day it just clicked. And I was able to really progress in my career. I happened to be the youngest promoted vice president within my organization at Thomson Reuters, and that was exciting. And all of my, above all of those 26 students in my class, and I attribute that to Washington College. But that's really, I got into it, but anything you get into, you have to work hard. You have to work hard, you have to persevere, you have to find your passion. If you're not passionate about something, I think it's very difficult to be uber successful. You can have money, and you can have fame, and you can have other things, but there's always going to be something that's unfulfilling. So, I landed in it, but I had great mentorship, and I took also the responsibility of what type of consultant did I want to be. Proactive, organized, helpful. So I never said no to clients, ever. And if that being a consultant and you want to be successful, it's a 24/7, right? Because you're serving anytime you're serving clients, it's 24/7.
Yes. Next question. How did you decide to create your firm, Corbin Advisors?
So I started my firm in 2007, as I mentioned, and prior to me starting and hanging my own shingle, as they say, I worked at Thomson Reuters. At that point, it was Thomson Financial, also a publicly traded company. And I had a company that was a large cap, mega cap media and entertainment company, and the CEO was going through a very public battle with his board and with his shareholders, and they wanted to separate the chairman and CEO role. And they were my client, and I was advising them on what was happening in the stock market and who was buying and selling their stock. And they came to me and said, will you interview our top 50 shareholders? Because I had been doing 1 interview a month for reports. And I put together this project, what is known as a perception study, which is the core of our business, but we've got lots of other businesses around it. And I had the opportunity to conduct this research for one of the biggest names in media and entertainment. And that was when I was 25 years old. I created the product. I worked around the clock to conduct those interviews. I had people calling me, shareholders calling me from their vacation because they wanted to participate in this study. I delivered that research, and I had the opportunity to present to the CEO and CFO of that company. And it helped them understand what was the angst that shareholders had for the leadership, and specifically the CEO. And so I built that into a very successful practice over a 4-year period. I was able to incubate that. I was able to build it out within Thomson. But I gave up my life, 80 to 90 hours a week, working weekends around the clock, boyfriends by the wayside, that I finally decided, you know what, I'm going to go in a different direction because the economics and the value of like giving up my life for what I'm doing, it had run its course. So I actually never thought about starting my own company. I thought about going to McKinsey or Boston Consulting Group. And as I started speaking with my advisors of, hey, what do you think about this concept and this idea? I met with 2 McKinsey partners who were husband and wife, and I explained what I did for Thomson Reuters Company. And I just didn't have the financial backing I did from my family. I didn't have anybody in my family that was a huge, business person. So I was really all alone without a lot of guidance, and that was very scary and daunting. But as I started to socialize that concept with some of my other advisors, I had former clients of mine who said, if you go into business, we will work with you. So that gave me confidence, and so I did that. In fact, one of my advisors was is sitting here. He's my husband now. He wasn't then. He's the only one that told me not to go into business, but mainly because he thought I could be a public company CEO. So that's how I got into Corbin. At the worst time you could ever start a business like mine, a great financial crisis, and I didn't have clients until 2008, but I had one client, Larry Feedy. Thanks, Larry. I always like to thank him because he believed in me. He was from United Dominion. It's a REIT, UDR. And he believed in me, and he was my first client. And from there, we took off. But while I didn't have clients, I started inside the buy side. And I conducted that research, and I used it as a marketing piece to be able to open the door to companies and say, hey, this is real-time, cutting-edge investor sentiment. This is what we're doing. Would you have time to talk to me? And it was just kind of grassroots movement to build. And now you see we're hundreds of clients, 70 associates around the world. It's been a fun ride, and for anybody who understands growth, we have a 45% CAGR over the past decade. That's Amazon level when they were in their hyper-growth phase. Obviously, we're a lot smaller, but we are a hyper-growth company, and we are on the path to double revenue over the next 3 years. Again, then it gets super hard. It's already hard, but.
All right, I'm going to open it up to questions from the audience. So,
I know we're running late here. I talk a lot.
I'm going to ask you guys to bear with us, and I'd like to get at least a couple of questions. So just raise your hand. Yeah, Joe.
It's for students, Joe.
No, it's for the
I'm a lifelong learner. Your growth trajectory is amazing.
Thank you.
So my question for you, you said that there's really not a lot of training or space for developing these investor relations within the company. How challenging has it been for you to hold on to talent while you're trying to fill the boat to move forward?
So I would say that very difficult. We've had, the hardest thing in the beginning is the turnover of the employees, because you're building something and you're like, just trust me. We're getting here, but you have to have people who want to roll up their sleeves, like Lucas, who was our first intern, by the way, and also a graduate of Washington College. Fun fact, we had the same birthday, January 10th. Captains. But it's really hard. But now I've built out my senior leadership team. We have a huge human resources and talent development program, and that we're investing hand over fist to really focus on our employees. Our culture is our lifeblood. Our people are our lifeblood, and we train people to do what we do, and it's very costly and timely if we can't maintain and keep their interests. So we spend a lot of time on making sure that our employees are happy and fulfilled, and that we're balancing their workload as much as possible.
Right, yeah, as Rebecca stated, back in 2015, I started as an intern, and I just saw the power that the company had with its Corbin Analytics, and I had the opportunity to work on building out that huge piece of our story. And it was so magnificent to get a full-time opportunity after graduating in 2016. And ever since, I've been working up my way from analyst and now most recently promoted to manager, where I get to lead a group of 2 to 3 people, helping execute best-in-class investor days. So it's been a pleasure, and I really enjoyed it.
Intense, but we don't have a lot of unforced turnover at this point. We really don't. I look at hiring as an employer. I look at it as a marriage. I truly do. We're entering into a relationship where we both have to have trust, and accountability and passion for what we're doing and for each other. And so, you know, we try to be very upfront with regard to who we are, what type of culture we are. We're maniacs. We are a true cult-like culture. We work because we love what we do, and we work a lot of hours, but that is very fulfilling to us. It's also draining, but generally it motivates us. And so we like to be upfront so that you know what type of relationship you're getting into, because nobody wants a breakup. The employee doesn't want to break up, and I as the employer don't want to break up. So I'm trying to crack the code on that in terms of just brutal honesty and truth and trust to be able to get to a point where there's symbiotic. And my goal is to change the 2-week notification when people resign to 4 weeks. So if you start to see that come out, you know where it came from.
What other questions do we have? I know students prepared questions.
I just had a question about, do you have a target number of employees that you want to expand to, or do you kind of play by ear by the situation?
So great question. We are more focused on our revenue profitability targets, but let's see here, we're about to be 70, and we're going to probably add around 15 this year. That's our hope. We may lose a couple, but we're really trying to maintain and grow. I can see this company where, you know, in 3 years probably at 125 people. Yeah.
But as you saw also, when I joined, there was only 7 people, and now you see it to 70, so that just gives good lens.
We've been on a tear. Yeah. We hire a lot of great people, and we are always looking for great talent. Always looking, again, I'm self-taught. Everything that I went through, I learned through the work that I did by listening to investors. So, you know, there's no real school for what we do in terms of the type of consulting that we do, the type of research. We teach everything in-house, but we love people who are hardworking, you know, just really strong work ethic, fun, loving, good people we can teach, and, you know, it's a great company to be with.
Anthony?
So are ESG funds a force for good, or do some companies want shareholders to believe that? Because you talked about ESG and how it's growing popularity, so I was just curious on what your thoughts are.
Well, do you think, let me reverse the question. Do you think that having lower carbon emissions is a good thing?
I was actually talking about this with my coach at lunch today. I think the idea is there, but it may not be the best way, because there may be
just answer do you think lower carbon in our planet is a good
No,
thing?
because I think it'll be a minuscule difference.
Okay. Do you think having women and people of color on a board and in leadership is a good idea? Okay. So my point is that there's not going to be a linear way, and there's going to be this, you know, kind of starts and fits, and, you know, we're going to try this way and it might backfire, we're going to try that way. But what's happening is that the funds, people like you and I who say, I want to invest in sustainable companies, are then pushing the investors to say, well, you have to do these types of things and care about the environment and care about human capital and care about not having, you know, lawsuits on you because you've been fraudulent in your books, all of these things. That's environmental, social, and governance. So net, I believe very strongly that the transformation that we're seeing with regard to companies becoming much stronger stewards and caring a lot more around their constituents is single-handedly been driven by the Wall Street and specifically investors like you and I wanting to have a better planet, a better environment for all. So I believe in the good of ESG. Is it 100% perfect? No. Not by any stretch of the imagination, but when I grew up, there were no women in the boardroom. There were no women in management. And now I can see my clients, and it's a small number, but it's the trend is your friend, as I like to say. I have many more women who are CFOs and CEOs, and that's just, you know, we want to reflect our culture in business. So I'm a big advocate of ESG. I really am. Yes.
In the back. Oh, sorry.
What are the steps to getting an internship at Corbin?
Oh, yeah, my friend. Our website, or you can reach out to Lucas Morgan, lucas.morgan@corbinadvisors.com. Lucas.
And I can answer any questions that
Yep.
you want.
Yeah, Alex?
This kind of goes back to the whole ESG thing, but obviously it has become a much more broad, but also niche concept at the same time. Do you think the anecdotes of not only shareholders, but also consumers on a basic level affect how much the companies you're advising are actually making these decisions, or do you think a lot of them are doing it on their own, aside of the point of not only investors, but also consumers, such as a lot of us here who may not be necessarily large shareholders, but we obviously still have opinion and we're still part of the community that these companies are trying to serve and impact in.
So I think consumers have a huge voice in terms of where you put your money and what you invest in. I wish that the consumers were a lot more vocal, especially I am a conservationist. It drives me nuts to go out to a restaurant and all the plastic and the containers and all this other stuff. I mean, it's just terrible. But I think consumers absolutely are driving that, and they are putting their money where their mouth is, and companies are feeling that. I mean, there's a reason why energy, up until this point in time, was completely out of favor, because consumers, investors were really not investing in them. Alternatively, on the investor side, for companies, there are companies that are absolutely doing this because they believe that this is the right move to make. Valmont is a great example of a company that we work with that, they're a water company. Same thing with Xylem Water. They are driving this charge, and they're using their leadership position in public company land to really drive and affect change. And then there are other companies that are not. And we all know some of those companies that are being dragged by investors, and they have activists that have forced them to care about things. So there's a mix. I am not a believer that, like this, we will no longer be using fossil fuels. There has to be a long-term transition from, we're just, the world is not at the same level of economic, maturity and development, so there is going to be a transition, but I think it's great that we're thinking about different ways. But again, lithium is a mining business, okay? So, as good and, great as lithium is, they are mining in Chile and China and other places, and they are extracting that from the earth. So so if you have this concept around oil, which is at the liquid hot core of the earth surrounding it, for probably some reason, why do we use oil in our cars, right? To cool things down. You start to extract that, you get climate change, right? So we're doing other things. So to your earlier question, I think we're going to find that some of these things that we're doing, which we think is really good, is going to turn out to be, detrimental at some point down the road, and then we're going to have to, rethink. But I think the general movement is a better one.
We maybe have one final question.
You got two here, maybe we could do two.
Yeah. Over here first.
Hi, my name is Nicole. So my question is, how do you manage both investor and manager relationships when agendas or expectations start to clash?
So fortunately, we're in the background, but our clients hire us to get a sense of what investors are thinking in a very deep way. We do a lot of benchmarking, and our clients do listen to that research. Our research has led companies to divest assets. It's led companies to create D&I roles or hire a chief sustainability officer. It's led companies to pay a dividend or not acquire companies. So they want to know what investors, at least our clients, do, because it has an impact. It's just like a consumer. If you said, I don't like the way this product works because it's too big in my hand and every time I try to pick it up, it doesn't turn on, whatever it is, that manufacturer, that company is going to be like, well, let's fix that problem, because she's not going to buy our product. It's the same thing with shares. And you see that companies that don't care about what shareholders think generally underperform, and they typically get activists. Now, there are some unicorns out there. But they're very, very hard to become a unicorn. Very hard to become a unicorn. Does that answer your question?
Last one. How do you think that being a businesswoman has created any advantages or disadvantages compared to your male colleagues per se?
I feel I am at a massive advantage. Massive advantage. I've never, and thank goodness and gratitude abounds for the women that were ahead of me. And I'm trying to do my part to change this landscape as well. I'm very often the only woman in a boardroom or with a management team. And I will call it out, by the way. I'll say, look around, and I have enough audacity and boldness to be able to do that because my clients love me, but I say, look around. I'm the only woman in this room. That's a problem. So I really feel it's an advantage. I've always had male mentors and bosses who wanted to see me succeed, and I continue to this day. So I've always felt, not necessarily that my womanhood was, everything, but it's, when you are, a drink of water in a desert, per se, where, there's not a lot of women doing this. We're called iron skirts on Wall Street, the girl, we call ourselves iron skirts, women on Wall Street and in business. And it's definitely something that I feel has helped me, and that I know, and I've brought in 50% of women, or 50% of our employees are women. So I'm trying to really democratize what some consider a very scary industry, which is finance and Wall Street and stocks. And again, trying to bring in as many females and young women into the fold to be able to have a career in this industry. But I love my male counterparts. I'm not, as I always say, we're equal but different. We're equal but different. And we should celebrate our differences because we've been around for a long time together, and we've got a long time to go.
Well, can we all thank Rebecca for... Rebecca, and thank you, Lucas, too. And there will be time, we have refreshments in the atrium, so please come and ask more questions to them as you enjoy your refreshments. Thank you all.
Thank you so much for this opportunity.